A 71-year-old woman walked into her bank on a Monday morning. She had banked there for over 20 years. She knew the tellers by name. She asked to withdraw $6,000 to pay for a new roof. Her contractor needed a deposit or he was moving on to the next job. She walked out with nothing. Not because she was being scammed, not because the money wasn't there. The bank froze her account on the spot, and under a law that most people have never heard of, they had every legal right to do it. Her contractor moved on. She sat in a house with a leaking roof for 3 weeks while her own money sat in her own account, completely untouchable. If you are 65 or older, I need you to hear this clearly. This can happen to you, not because you did anything wrong, simply because of your age. My name is Eduardo. I'm not a lawyer. I'm not a CPA. But for years, I have dedicated myself to understanding the financial rules, benefit changes, and banking policies that directly affect seniors. The stuff that nobody sends you a letter about. The stuff that costs people real money, real time, and real stress. Not because they made bad decisions, but because nobody told them what changed. Today I'm going to walk you through exactly what is happening at banks right now in 2026, why seniors are being targeted by their own financial institutions, with good intentions but devastating consequences, and most importantly, what you can do about it before it happens to you. Stay with me. This one is important. So let's start with the why, because I think once you understand why this is happening, the rest of this makes a lot more sense. For a long time, banks could see when something looked off with a senior customer's account. They could warn you, they could ask questions, but they could not stop the transaction. If they delayed your money and turned out to be wrong, you could take legal action against them. So in most cases, the money moved, even when it probably shouldn't have. The problem is that financial fraud against seniors became an absolute crisis. We're talking about more than $3.5 billion lost every single year. Entire retirement accounts gone in one afternoon because someone called pretending to be from Medicare, or the IRS, or even a grandchild in trouble. So lawmakers stepped in and gave banks more power. They passed what are called safe harbor laws. And as of 2026, more than half of all states have one of these laws on the books. Here's what a safe harbor law means in plain English. If your bank believes, even just suspects, that you are being financially exploited, they can freeze your account, hold your money, and delay your access. And you cannot sue them for doing it. They are fully protected by law. The legal term used in these laws is specified adult. And a specified adult is anyone 65 or older. That's the line. The day you turned 65, you entered a legal category that gives your bank a level of authority over your money that they simply do not have over younger customers. Now here's the part that really gets me. The hold window in most of these laws is 15 business days, not calendar days, business days. Weekends don't count. Federal holidays don't count. A freeze that starts on a Wednesday before a holiday weekend can stretch into nearly 4 full calendar weeks. 4 weeks of direct deposits landing in your account that you cannot touch. 4 weeks of bills, groceries, prescriptions, all while your money sits right there with your name on it. And the bank owes you zero compensation for any of it. Now, I want to be fair here. These laws were written with good intentions. They were designed to protect the grandfather who almost wired his life savings to a fake lottery. The widow who got a call from someone pretending to be her bank. That threat is real, and it is serious, but here is the gap that nobody is talking about. Banks are not reviewing your account with a human being who sits down, looks at your history, and thinks carefully about your situation. They built automated systems In many cases, artificial intelligence that monitors your spending patterns and flags anything that breaks from your normal behavior. And that system cannot tell the difference between a scam and your real life. It doesn't know you. It doesn't know your family. It doesn't know that you're withdrawing money for a home repair or that you're sending money to your daughter for the first time because she just had a baby and needs help. It only knows patterns. And the moment your behavior breaks a pattern, it reacts. So what breaks the pattern? Let me walk you through the most common triggers I see. The ones that are catching real seniors with honest money in 2026. The first one is a large or unusual withdrawal. Your bank has been quietly building a profile of your financial behavior. Your average monthly withdrawal, your typical transaction amounts, your normal routine. And the moment you ask for something outside of that range, even if it's completely legitimate, the system flags it. This isn't a fixed number like 10,000 US. It's relative to you. If you normally take out $500 a month and you walk in asking for $4,000, that alone can be enough to trigger a review and a freeze. What do? You call your bank 3 to 5 days before any large withdrawal and you say, "I'm planning to withdraw X dollars on this date for this reason. I'd like that noted on my account." That one call puts a legitimate explanation on your file before the algorithm has a chance to invent a suspicious one. The second trigger is a change in how you bank. This one surprises people because it has nothing to do with the amount of money. It's about behavior. Banks track the device you use to log in, the time of day you access your account, the location you're logging in from, and even whether you're using a new phone. Logging in from a new device, accessing your account from a different city while traveling, using a payment app like Zelle for the first time, any of these can flag your account. None of them mean anything is wrong, but to the system, they look like warning signs. The fix is simple. Anytime something in your life changes, new phone, travel plans, sending money to someone new, make a quick call to your bank first and let them know. You're writing your own explanation before the machine writes a worse one. The third trigger is something called structuring, and this one is serious. You may have heard that withdrawing $10,000 or more triggers a federal report. And maybe you thought, I'll just take out $9,000 today and $9,000 next week to keep it simple. I need you to stop right there. That is a federal crime. It's called structuring. And it doesn't matter that the money is 100% yours and completely legal. The act of breaking up withdrawals specifically to stay under that reporting threshold is itself illegal, regardless of where the money came from. The IRS and federal financial enforcement agencies have seized entire bank accounts from people who were never charged with any other crime. People with completely honest money lost everything because of the withdrawal pattern. If you need a large amount, take it in one clean transaction. Let the federal report be filed. For honest money, nothing happens. That report is routine. The danger was never the report. The danger is the pattern that looks like you were trying to avoid it. The fourth trigger is what I call the dormant account sweep. This one is quiet. You have a savings account you set aside years ago. You're being responsible. You're leaving it alone, letting it grow. The bank has a different word for that: abandoned. In most states, if there is no owner-initiated activity on an account for 3 years, and in some states just 1 year, the bank can legally transfer your money to the state government as unclaimed property, without a phone call, without a notice you'd actually notice. And here's the detail that catches people. Automatic activity doesn't count. Interest being credited to your account every month does not reset the clock. The clock resets only when you initiate something: a login, a transfer, a withdrawal. There is currently over $77 billion in unclaimed property sitting in state government accounts across this country. Most of it belongs to people who have no idea it was taken. Every January, log into every account you own and make one small owner-initiated transaction. $1 in, $1 out, anything. That resets the clock for another full year. And if you want to check whether money has already been swept, go to missingmoney.com. It's the official multi-state database. Free to search, free to claim. Now that you know what triggers a freeze, let me give you the protection layers. These are the things that make you nearly impossible to freeze, and most of them cost nothing. Layer 1. Add a trusted contact to your account. Almost every bank now allows you to name a trusted contact. This is not a joint account holder. This person cannot access your money or see your balance. They are simply someone, a son, a daughter, a close friend, whose name and phone number you give the bank in advance. Here's why it matters. When the system flags your account and compliance is about to place a freeze, the trusted contact gives them an alternative. They make one phone call. Your daughter confirms you told her about the withdrawal. Your son says yes. Dad mentioned he was sending money for the grandkids. The freeze never happens. You never even know it almost did. Call your bank today, not this week, today, and say, "I'd like to add a trusted contact to my account. Can you walk me through that?" 5 minutes. Done. This is the single most powerful thing you can do right now. Layer 2. Always announce before you act. Any large withdrawal, any new device, any travel, any transfer to someone new. Call first. Give the bank a reason before the algorithm invents one. Announced money does not look like stolen money. Surprise money does. Layer 3. Have a backup account at a second institution. Never let one bank control your entire financial access. If your primary account gets frozen, a second account at a different bank or credit union means you are never completely cut off. You can still pay bills, buy groceries, fill prescriptions. Keep 1 month of essential expenses in that backup account and leave it there. For most seniors, that's somewhere between $3,000 and $4,000. That amount sitting in a second account is the difference between a crisis and an inconvenience. Layer 4. Make sure your power of attorney actually works. If you have a POA, call your bank and ask, "Do you have a preferred form or specific language requirements for powers of attorney that you will honor?" Many major banks have their own form. A generic document downloaded from the internet gets rejected constantly, and a POA your bank won't accept is the same as having no POA at all. Layer 5. Do an annual account audit every January. 30 minutes. Once a year. Log into every account, make one owner-initiated transaction, confirm your trusted contact is still current, verify your POA is on file, and check your beneficiary designations. That's it. One annual review keeps every protection layer working. Look, I want to be honest with you about something before I go. These laws were not written against you. The banks are not your enemy here. These systems were built because real criminals are stealing billions of dollars every year from real seniors who worked their entire lives for that money. The threat is real. But the system cannot tell the difference between a scam and your normal life. And that gap between what the system was designed to do and what it's actually doing to innocent people, that gap is where your retirement money is at risk. The good news is that closing that gap doesn't require a lawyer, a financial advisor, or anything complicated. It requires a few phone calls, a backup account, and one 30-minute review every January. The seniors who never get frozen aren't luckier than the ones who do. They're simply prepared. I cover this kind of thing. The rules, the changes, the traps built into the system that nobody sends you a letter about, because you deserve to know before it costs you, not after. If this helped you today, Share it with someone you know who is over 65. You might be the only person in their life who passes this along. I'll see you in the next one.